Treasury yields moving lower ahead of a fresh reading on consumer confidence and key inflation reports later this week. Investors are eager to get a better understanding on where the Fed stands after the meeting minutes from the FOMC's latest meeting showed uncertainty over when rate cuts might take place. April's personal income and expenditures is expected to clock in at an annual gain of 2.8%. That's flat from March's increase. For more, we're joined by Michael Goosay, who is the principal asset management chief investment officer of Global Fixed Income here. Thanks so much for taking the time here with us this morning. Okay, so we got some Fed speak. We've got some data that we're going to get over the course of this week. Does any of this change what we see at the next meetings and ultimately the pathway for rate cuts that everyone is so much been anticipating coming into the start of this year, but at this point, it seems like we're going to get fewer than expected?
Yeah, good morning, and thank you for having me on today. Certainly the data has brought into question the amount and the timing of whether the Fed's going to cut policy rates or not. The economy's remained relatively robust. Inflation has been maybe a bit stickier than what some had hoped for. Certainly that's been played out in the last few months. But overall, we've seen a material improvement in the inflation picture. And the economy, as I said, remains pretty healthy. That doesn't necessarily mean the Fed's going to be cutting rates imminently, but it certainly could imagine that given the progress we've made on inflation post-COVID, post the normalization of some of the quantitative components of the way that the Fed conducts monetary policy, that they could be moving on policy as soon as September. It could take some more improvement in some inflation data, but overall that what we've seen to date may be enough for them to start cutting rates as early as September.
Michael, what are some of the fund flows that you have noticed specifically within fixed income and this reallocation that we've seen from the short duration into more longer term duration, and whether or not you think that trend has legs here, given what you just said?
No, excellent point. I think the flow into money market funds and shorter duration product was significant over the last couple of years as the Fed tightened policy, and you could earn in your checking account, your savings account, and your money market fund over 5%. Something we haven't seen for a long time. As the expectation for the Fed to cut policy rates starts to emerge, you do tend to see that shift from shorter duration to longer duration. This is a trend that you've seen in all kinds of environments when the Fed does pause, when the Fed does start to position for cutting interest rates, is that duration becomes your friend. You want to move out the yield curve, and we're starting to see some of that really take shape.
Okay, so with that in mind, what is the portfolio allocation that investors should be considering with regard to some of the fixed income exposure that they have versus equities?
So versus equities, fixed income is now offering attractive risk-adjusted returns. You can get an all-in yield of between 5 and 6%. If you compare that to something a little bit lower in quality like high yield, you can get closer to 7 or 8%. So there is attractive risk-reward opportunities in migrating from equities to fixed income. But even just a reallocation, imagine equities have outperformed pretty significantly over the last year, and a reallocation from equities to fixed income we do think is prudent at this time.
Michael, when it comes to the expectations of the bond market, we really have been talking about that just in terms of the leading indicator, in terms of those rate cuts, the expectations there. How much of that has already been priced in at this point? And if not, do you expect to see maybe some continued volatility leading up to that first rate cut?
Yeah, no, that's a great question. Just a little history lesson. If you go back to December of 2023, there were almost 7 rate cuts priced into the market. And as the data that I referenced earlier started to come in a little stronger, those were slowly taken out. And despite that, fixed income performed well, equities performed well because the economy was doing okay. So, when you get to these periods where of the inflection point from an economic cycle perspective, you definitely should expect to see more volatility, and we have seen that. And so that would be, setting us up for latter part of this year. The question marks around, does inflation start to move towards the Fed's 2% target? Does the economy show signs of some weakness, particularly in the labor market? being those early indicators that the Fed will start to move on policy.
Michael Goosay, who's the Principal Asset Management Chief Investment Officer of Global Fixed Income. Thanks so much for taking the time, Michael.
Thank you.